Silver just entered a phase where the physical market starts dictating terms, and the paper market is already trying to act like nothing changed. But the next 72 hours are where that little act gets expensive, because the hidden pressure isn't in the headline spot price, it's in the can you actually source it, deliver it, hedge it, and settle it, plumbing that most people never look at. And by the end of this video, you are going to have three things: the one metric that tells you whether this move is real or just a spike, the levels that matter if we get a violent shakeout, and a simple checklist for what to watch this week, so you don't get played by the volatility. Right now, silver is doing something that makes markets uncomfortable. It is forcing a conversation about availability, not opinions. And when that happens, the price on a screen can lag the price in the real world because screens clear instantly and supply chains don't. That's the conflict. Futures can trade 1,000 times before a single bar moves, but the moment physical tightness shows up, spreads start talking, premiums start talking, and inventories, specifically the deliverable slice, start talking in a way that's hard to ignore. And that's where the real pressure starts. Over the past few weeks, silver hasn't just moved, it's sprinted, running from the low 70s per ounce earlier this month into the 90s, with prints around the mid $90 area right now, which is an extraordinary speed for a market that normally likes to pretend it as calm and orderly. That kind of acceleration matters because it changes behavior, it changes margin requirements, it changes dealer hedging, it changes how shorts manage risk, it changes how quickly a wholesaler is willing to quote you a price without a big cushion. And when all those micro decisions change at once, you get the exact thing we're seeing: premiums lifting inventory stress, showing up in the parts of the system that actually deliver, and a whole lot of people trying to talk you into believing it. That's just excitement, and it will fade. But that's not the part that matters. The part that matters is whether the market is tightening from the inside out. Because if it is, the next move isn't driven by mood, it's driven by mechanics. This move isn't emotion, it's math. Start with premiums, because people love to dismiss premiums as retail noise, and that's a lazy read. Premiums are a real-time signal of replacement risk. If a dealer can sell you a coin today, but can confidently restock it at the same cost tomorrow, they widen the premium not because they're greedy, but because they're remanaging the risk of being short physical in a market that gapping. And when a lot of dealers widen at once, it tells you something important. It's not one shop being dramatic, it's a supply chain getting sticky. You'll hear a lot of, there's plenty of silver talk, sure. But plenty of silver in the world is not the same thing as plenty of the right form of silver, in the right place, on the right timeline, to meet immediate demand. That distinction is the entire story, and that's your hidden detail. Not all inventory is created equal, and the deliverable pool is the bottleneck. On exchanges like COMEX, there's typically a split people gloss over: eligible versus registered. Eligible metal meets the specs, right purity, right bar form, sitting in approved warehouses, but it is not necessarily committed for delivery. Registered metal is the metal that has been warranted, assigned, and is actually deliverable against futures. That sounds like a technical footnote until you realize something. When the market gets tight, eligible can sit there looking big on paper, while registered gets drained. And the thing that matters is registered, because that or-s the pool that can actually satisfy delivery when contracts stop being just paper games, and someone says, no, I want the metal. And that's where the real pressure starts. Inventory doesn't have to vanish globally for the deliverable pool to get stressed. Metal can be reclassified, it can be pulled for private deals, it can be moved to a different location where the bid is higher, it can be earmarked, it can be held back because the owner doesn't like the terms. In other words, the inventory drain is often a drain from the delivery system, not a drain from planet Earth. And if you've ever watched a market where delivery matters, you know the same pattern. The headline price lulls people, while the spreads in the deliverable category start screaming. But that's not the only layer, because if this one level breaks, the math changes. Let's talk a term structure, the futures curve, because this is where grown-up information lives. When the market is comfortable, you tend to see contango. Later months priced a little higher than near months, reflecting storage, financing, and time value. When the market is stressed, you can see backwardation or near-month strength. The front end trades rich because the market wants metal now. It's a scarcity premium expressed through time. And here's the key translation. That curve shape forces behavior. If near-month spreads tighten or invert, shorts who plan to roll their position forward can find that roll getting expensive. Dealers who hedge physical sales with futures can find their hedge costs rising. Arbitrage desks that normally smooth everything out can get constrained by logistics, credit, or bar availability. And the next detail is what flips the whole setup. When spreads go from boring to urgent, you can get a reflexive loop. Tightness makes spreads stronger. Stronger spreads incentivize pulling metal forward. Pulling metal forward tightens deliverable supply, and that tightness feeds back into spreads. That's how a market goes from rally to problem. Now, zoom out for a second, because skeptics will say, fine, but if silver is tight, why do we still see big vault totals in places like London? Good question, and it's the perfect counterpoint because it keeps us honest. London vault data can show large holdings, and in fact, recent official snapshots have shown London silver holdings in the tens of thousands of tons. That tells you the world isn't out of silver, but it does not disprove tightness in the parts of the chain that are actually under stress. London bars, exchange deliverable bars, retail coin blanks, and industrial feedstock aren't perfectly interchangeable on a moment's notice. Form factor matters, location matters, ownership matters, time matters, refining capacity matters. And that's why this isn't a cartoon shortage story. It's a bottleneck story, a supply chain story, a market structure story. And those are the kinds of stories that explode in short windows, like the next 72 hours. Because once liquidity thins, the marginal buyer sets the price, and the marginal buyer doesn't care about your narrative. They care about clearing a risk problem. Here's what inventory drains actually looks like in real life. A large holder decides they don't want their metal in the deliverable category anymore, so it gets dewarranted, moved from registered to eligible, or pulled entirely. A fabricator needs feedstock and is willing to pay up for immediate delivery, so they pull bars out of a warehouse and into production schedules. A wholesaler has commitments and starts bidding aggressively for supply, which forces dealers to either raise premiums or stop quoting size. Meanwhile, the futures market keeps trading, but the physical chain is dealing with lead times, shipping, assaying, converting forms, and those lead times mean the market can't instantly arbitrage away a premium. That S why premiums can stay high even when spot looks like it is not that crazy, because the bottleneck is time. And time is what the curve prices, but that's not the part that matters. The part that matters is what participants are forced to do next. So let's stack proof, because one argument is never enough in markets. Proof point one, the speed of the move itself. When silver runs from the low 70s to the 90s in a matter of weeks, you don't just get new buyers, you get forced risk management. VAR models light up, margin requirements rise, position limits get tighter. That alone can cause liquidation in unrelated books, and it can cause shorts to reduce exposure even if they still think they were right. Markets don't care what you think when your risk manager cares what you owe. Proof point two, premiums and retail availability. You can see dealers quoting wider spreads, out-of-stock notices, delayed shipping, and rapid repricing. Even if you don't buy retail, this matters because retail is the canary for distribution tightness. When the distribution chain is strained, wholesale bids rise, and wholesale bids feed back into hedging behavior. Proof point three, the curve and spreads. If near-month spreads are firming and the front end is trading like it wants metal now, that is a structural signal. It's not a vibe. It's the market putting a price on immediacy. Proof point four, institutional pathways. When a market is hot, demand expresses wherever it can. That can be through ETFs, ETPs, through OTC deals, through futures, through direct physical procurement. You don't need to pretend you can see every flow. You just need to understand the logic. If investment demand is rising at the same time physical premiums are rising, it means pressure is not confined to one channel. It's broadening. Proof point five, global catalysts and macro drivers. Silver doesn't trade in a vacuum. Right now, you've got a combustible mix, geopolitical tariff threats, risk-off pulses, and the kind of uncertainty that drives safe haven behavior while also messing with industrial planning. When headlines hint at trade disruption, companies that rely on metals don't wait for clarity. They front-load procurement, they build buffers, they lock contracts. That's how demand can jump even without a perfect new technology story. And proof point six, because you always want one more layer, the psychology of the tape. When a metal starts printing new highs, it attracts trend followers and momentum funds, but it also attracts sellers who believe it can't last. That creates a positioning battleground. And if the market keeps grinding higher despite attempts to smash it down, that's often a sign the sellers are leaning into a wall that's not moving. But that's not the part that matters. The part that matters is the forcing function, and the forcing function is calendar plus liquidity. Let's talk about the next 72 hours, because the title isn't next year, it's right now. This is a window where two things happen at once. Liquidity can get thinner than people expect, and catalysts cluster. You get macro data, you get central bank chatter, you get geopolitical headlines that drop at awkward hours, and you get positioning pressure as traders stare at month-end approaching and start deciding whether they want to carry risk. In metals, those windows can be brutal because silver is the kind of market that can gap on you, up or down, before you've even finished forming an opinion. And that's where the real pressure starts. Here's the mechanism that catches people. When price is high and volatility is high, option dealers and hedgers can amplify moves. If there is a big cluster of call options at round numbers, like 100, then as price approaches those strikes, hedging flows can turn into forced buying. That's delta hedging. Dealers who sold calls hedge by buying futures as the price rises, and that buying can push price higher, which increases delta, which forces more buying. Reflexivity. On the way down, the same process can flip and accelerate dumps. You do not need to worship this as a magic explanation. You just need to respect it as gasoline. It doesn't create the fire, it feeds it. The fire is physical tightness plus risk demand plus macro uncertainty. The gasoline is positioning and hedging flows that can turn a normal move into a vertical one. So what does that mean for you this week? It means you should stop expecting clean price action. If the thesis is correct, if physical pressure is real, silver can still whip around violently. You can get a sharp dump that looks like the end, followed by an even sharper rip that looks like a squeeze, all inside the same 24 hours. The market will try to make you emotional. It will try to make you feel late at the top and terrified at the bottom. That is how it transfers metal and money from impatient hands to disciplined hands. And that's not a conspiracy. That's market structure doing what it does. But that's not the part that matters. The part that matters is learning to separate trend signal from noise. Trend signal is the behavior of spreads, the persistence of premiums, the market's ability to hold key levels on pullbacks, and the way it reacts to catalysts. Noise is the intraday whip that exists to clear leverage and trigger stops. So let's get concrete, because you deserve actionable structure, not motivational speeches. Key levels. In a market like this, round numbers matter more than normal because positioning clusters around them. The $100 area is the obvious magnet and battleground. Below that, the mid-90s zone, where we are hovering now, matters because it's a new regime time zone. If price can base here, it tells you the market is accepting higher prices rather than rejecting them. The first big psychological support is the $90 handle. If silver can dip toward $90 and snap back quickly, that's often a sign of strong hands absorbing supply. If it loses $90 and can't reclaim it, you start watching the next shelf, think mid-80s, where earlier breakouts and consolidation could have formed. And here I ask the line in the sand concept. You don't need one precise number. You need a zone that, if lost and not reclaimed, tells you the move is likely shifting from structural repricing to blow off and unwind. Because if this one level breaks, the math changes. Hedging flows can flip, leveraged longs can puke, and premiums can behave weirdly because dealers protect themselves by pulling quotes rather than lowering prices immediately. That's why you can see spot down and premium still stubborn. It's replacement risk again. Now the two scenario lens, because credibility lives here. Scenario one is the controlled pullback and retest. In this path, silver dips, maybe on a macro headline, maybe on a squeeze of the dollar, maybe on a rate spike, tags a support zone, spreads stay relatively firm, premiums don't collapse, and then price reclaims the prior level. That's a healthy reset. That's the market shaking out leverage and then continuing the trend. Scenario two is the continuation squeeze and gap risk. In this path, silver doesn't give you the polite dip. It grinds higher into key strikes, liquidity thins, spreads stay tight, and then you get air pockets, fast jumps, because sellers step back and hedgers step in. That S where you can wake up to a market that moved several dollars while you were asleep. That's also where your risk management matters more than your opinion. Both scenarios can be true in the same week. You can get a squeeze, then a violent retest, or a retest, then a squeeze. The market will not schedule volatility around your comfort, but that's not the part that matters. The part that matters is what confirms or invalidates the premiums up inventory draining story. So here's the real-time dashboard for the next week or two. First, watch physical premiums and availability. If premiums remain elevated or rise even when spot dips, that's supportive. It tells you the physical bid isn't just chasing price, it's dealing with supply friction. If premiums collapse quickly and availability floods back, that weakens the story. Unless it happens because spot overshoots and demand pauses temporarily, which can happen. Second, watch the front end of the futures curve and spreads. Are near-month spreads staying firm? Are they tightening when price rises? That suggests urgency. If spreads loosen dramatically while price is high, that can be a sign the market is getting supply relief or that the front-end demand is cooling. Third, watch deliverable inventory behavior. You don't need exact numbers to understand direction. If the deliverable category keeps bleeding while eligible stays flat or rises, that's the exact hidden detail pattern. Deliverable is the bottleneck. If registered rebuilds smoothly, that suggests the system is replenishing and the stress may ease. Fourth, watch the macro tripwires. The dollar, real yields, and risk sentiment. Silver can act like a monetary metal and an industrial metal at the same time, which makes it a beautiful liar and a brutal teacher. A sharp dollar rally can smack silver even in a bullish regime, but if silver shrugs off dollar strength, that's a tell. Fifth, watch for the street symptom that always shows up in real tightness: delayed fulfillment, rapidly changing quotes, wholesalers limiting size, industrial buyers locking in contracts earlier than usual. You won't see all of this on a chart. You'll feel it in the way the market talks. Tight bid, ask one moment, then no quote, then higher premium. That's the system protecting itself, and that's where the real pressure starts. Now, let's address the skepticism directly, because I know a lot of you don't buy the dramatic narratives, and honestly, you shouldn't. The world is full of metal stories that sound spicy and end up being nothing. So here are the clean counterpoints, and the rebuttals grounded in mechanism. Counterpoint 1, premiums are just retail hype. Sometimes, yes, but retail hype doesn't usually persist across multiple dealers unless their replacement costs are uncertain. The moment wholesale restocking gets weird, premiums become signal, not noise. Counterpoint 2, there's plenty of silver in vaults. Yes, but plenty in vaults doesn't mean plenty deliverable where it needs to be, in the right form right now. Bottlenecks create premiums and spread distortion long before the world runs out of anything. Counterpoint 3, if it's tight, why is price still so volatile? Because volatility is what happens when liquidity thins and positioning gets crowded. Tight markets are often more volatile, not less, because the marginal order moves price further. Counterpoint 4, this is all just geopolitical fear. Geopolitics can be a catalyst, but it doesn't explain physical premium persistence or deliverable category stress. It explains urgency, not the plumbing. The plumbing explains the shape of the move. And the next detail is what flips the whole setup. When the market transitions from price up to settlement tension, the participants who can't access physical are forced to express demand in the paper market. And that bounces when the paper market stops being a detached casino and starts being a pressure valve. Futures become the place where people hedge the fact that they can't get metal easily. That's why the screen price can surge even faster than physical availability improves. Because price is the rationing mechanism. It's the system saying, fine, if you want it now, pay up. And if you're sitting there thinking, okay, cool story, but what do I do with this? Here is the clean answer. You do not need to do anything impulsive. You need to observe like a professional. The biggest edge you can build in a market like silver isn't predicting the next dollar. It's not getting emotionally hijacked, because the market will use volatility to manipulate you in two predictable ways. First, it will punish FOMO by ripping higher just enough to make you chase, then dumping hard to make you regret it. Second, it will punish conviction by dumping hard enough to make you capitulate, then ripping back the moment you're out. That emotional whiplash is not an accident of nature. It's what happens when leveraged participants have to adjust, and the path of maximum pain clears positions. So your psychology shield is simple. Decide ahead of time which time frame you're operating on. Decide ahead of time what level or condition would invalidate your thesis, and treat everything else as noise. If you're watching the next 72 hours, you're playing a different game than someone watching the next 12 months. Confuse those games, and you will get wrecked emotionally, even if the big picture is right. And that's where the real pressure starts, inside your own decision-making. So let's bring it back to the promise, the payoff, the timeline, and the checklist. Over the next 72 hours, the market is going to be hypersensitive to catalysts, and silver is sitting at a level where every participant is aware of the optics. New highs attract attention. Attention attracts flow. Flow attracts hedging. Hedging amplifies moves. And meanwhile, physical premiums are the background drumbeat telling you whether the move is backed by real tightness or just hot money. The specific hidden detail you need to tattoo on your brain is deliverable versus non-deliverable inventory. If the deliverable pool stays tight, the market stays in a posture where spreads can remain firm and pull price higher, even on dips. If deliverable supply rebuilds and premiums soften materially, the market can cool without collapsing, and you should expect a more normal consolidation. Either way, volatility stays. That's not fear, that's structure. Now, targets, without pretending we can see the future. The upside magnet is obvious, $100. It's psychological, it's positioning, it's media friendly, and it's the kind of number that turns casual interest into mania. If silver pushes toward $100 with firm spreads and stubborn premiums, that's a setup where continuation becomes plausible. If silver tags near $100 and reverses sharply with spreads loosening and premiums fading, that's a setup where a violent retest becomes likely. The invalidation concept is equally simple. If silver loses the 90 zone and can TE reclaim it after multiple attempts while physical signals also cool, then the thesis that physical is dictating terms right now weakens, and you should expect a deeper unwind toward prior consolidation zones, likely in the mid-80s range. That doesn't mean the long-term story is dead. It means the immediate squeeze dynamics or scarcity signals are easing. Trend signal versus noise, that's the discipline. And here's your next week checklist in plain language. Watch premiums and availability, watch front-end spreads, watch deliverable inventory direction, watch the dollar and yields reaction to macro prints. Watch how price behaves around $90 and $100, and watch whether dips get bought quickly or linger. If dips get bought fast and physical stays tight, pressure remains. If dips linger and physical eases, pressure is releasing. And that S where the real pressure starts, when the market reveals what it truly values, time and certainty. If you are the kind of investor who hates being spoon-fed narratives and would rather track the signals that actually move price discovery, you're in the right corner of the internet. Stay with the people who watch the plumbing, not the pundits. Keep your eyes on spreads, premiums, and deliverability. Let everyone else argue about vibes. And if you want to keep building that signal-based approach with a group that doesn't tie panic buy tops and panic sell bottoms, then stick around, because this silver tape is going to teach a lot of people an expensive lesson, and I'd rather you be the one reading the lesson than paying for it.